Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Boy, oh boy, I am excited because y'all asked me to break down a balance sheet, and I'm like, I haven't done that before, and I get to really get back to my roots and teach and write on the whiteboard and do all that type of stuff. So this is the video that you want to like and subscribe. All of them you want to do that, but this is definitely one of those because I'm going to give you a bunch of value in how to understand what a balance sheet is, what it tells you, what it doesn't tell you, how to find it, and all the information that you need to know. I'm going to try and do this within 15 minutes. Obviously, balance sheets can get real complicated real quick, but we are going to boil it down to a basic level that you can understand and use. And as a good teacher, as a teacher and award-winning educator that I am going to ask you to do some homework with me. Okay, so as we're going through this video, I would ask you right now, yes, right now, to either pull up your favorite company and find the balance sheet. I'll show you how to do that, but find the balance sheet or do the exact same things I am doing on the screen and find the balance sheet for the company that we're going to talk about. That way you can really the basis of learning, and really when it comes to the stock market, is by practice and by understanding and by repetition, but most importantly by practice and doing experiential learning. That's where the good stuff is, and it's what I teach my students inside the investor toolkit and almost everything else I do. All right, so let's first talk about what a balance sheet is and what it isn't and how it fits into the context of investing. Now, a balance sheet tells us immediately how much a company is kind of worth in one way. Think of it like an individual. We judge individuals in terms of as net worth. We say, oh, you're worth X amount. Elon Musk, you're worth X amount. Kanye West, whomever else, right? I guess those are two problematic people. But aside from that, we look and we say net worth, and this person is a billionaire or whatever. We're really looking at their balance sheet. And companies are similar. It doesn't tell me everything. Does not tell me everything. In fact, it doesn't tell me how much the company made. It just tells me how much you have. It is a snapshot in time, a financial snapshot on that day. That's it. Okay. And a balance sheet shows us their assets. That is, maybe it's a factory, maybe it's cars, trucks, vans, the cash that they have, their accounts receivable, which means I've sent out an invoice, y'all owe me some money. That is an asset to me because that money should be coming in at some point. It could be shoes if I'm Nike. It could be clothing. If I'm Coca-Cola, it could be the drinks. It could be the land that I own and the factories that I own because I can sell it. That is worth something. That is going to show up on my balance sheet. But also it is your assets, which equals your liabilities plus shareholder equity. Your liabilities, the lease that you may own on that building. It could be loan payments that you have, or bills, loan payments or bills that you have to spend but you haven't spent yet. That's a liability, right? And then you have your shareholder equity. It's really the investor part. Like how much of this whole company is mine, right? How much have I put in as an investor, or really what's left after we take that income, the money that we have, the assets, we pay the liabilities. Well, everything else is mine, and that's where we come up with shareholder equity. So in this equation, it is assets equals liability plus shareholder equity. And it's going to make a whole lot more sense once you see the visual. All right, so I'll show you where to get it. I have a favorite place that I get it, but you can really get this information in a lot of different places. So today we are going to break down, and I've given you plenty of time to pull up a stop. That whole background information, that was your chance. That was your chance. I was stalling to help you pull up any company that you wanted to pull up. All right, so let's go ahead. I'm going to talk about Dick's Sporting Goods because I like Dick's Sporting Goods. Number one, bought some golf clubs there the other day. Number two, I talked about Dick's Sporting Goods and did an entire video on why I liked them last year. The day they were up 7%. It was close to 7%. It was exciting. So this is the company I'm going to break down. All right, so the first thing you can do is you can just Google Dick's Sporting Goods or any company annual report or financial statements, and you're going to get forwarded to the website. It's going to be in the first search results in most cases. So annual reports, you can go to the 2020 annual report, or you can go to their quarterly reports. There is an advantage and disadvantage between quarterly and annual. Annual is going to give you way more information, but obviously you got to wait a year to get the most updated info. In this case, for Dick's Sporting Goods, I only got 2020. Their 2021 report should be coming out here pretty soon. I can look up an investing calendar and figure out what date, but today is the day that it is, and that's the day that we're going to talk about. So it is what it is. But if I want to look at quarterly results, I'm more than free to do that. And maybe I can pour through and see what their quarterly results are and pull up, what their finances were and all that kind of stuff. But again, I like to focus on the annual report because it gives me more information in most cases. But again, that information might be dated, right? So if I'm making an investment in 2020 or 2022 rather, I really want to see that 2021 report. So that would really matter to me. But again, to break it down, we're going to start with the 2020 report. Another place that you can find this is on Yahoo Finance. It's very similar for CNBC or Bloomberg or whatever app that you may use. And I'll back up first. Is when you come to Dick's Sporting Goods, at least on your computer, you're going to be put on this screen first. I can scroll across the top and go to financials. I'm going to hit that. And then it's going to give me the 3 statements that every company must have. And if you are what we call a fundamental analyst, right, an investor who doesn't really focus on charts, they focus on the numbers. Fundamentally, how much money do you have? How much are you making? Are you growing? I want to see the books, right? This is what most people focus on. It's what Warren Buffett usually focuses on. So we have our income statement that tells me how much money is coming in. This tells us some important things. Is that income growing? Are you making more money over time? Are you losing more money over time? What are you spending your money on? All those types of things are here. You have your balance sheet, which we're going to talk about today. You have your cash flow statement. This really tells us how did you spend the money, right? It's one thing to say you made $2 billion. It's another thing to say, of that $2 billion, I spent my money on CEO compensation. I spent my money on dividends. I spent my money on other places. I might want to know that. Are you spending your money investing and reinvesting in the company and growing the company? Or are you spending it on debt and other things? Okay, so that is what the cash flow statement tells us. And then we go to balance sheet. Now, if y'all want other videos on cash flow statement and income statement, y'all know what to do. Just comment and let me know. All right, so I go to balance sheet. And it's going to give me a lot of information here. Now, again, I like to get it from the company page. The advantage of getting it from Yahoo Finance, assuming you don't have to pay, is you might, it might be easier to see everything in the exact same format. Some companies, their statements and stuff look better than others. Okay, so that totally is going to depend. But I like relying on the company itself and what they have in their statements. All right, so I'm going to go back here. And this is on page 54 out of their 90-page report. Now, this entire thing, this is their entire annual report. The balance sheet is just one page, thankfully for us. Now, I do like to pour through certain sections of an annual report to just help me understand what is the CEO about? What does the business do if I'm not already familiar with it? What do they focus on? What are the challenges? Again, I can do an entire class on that. But again, the balance sheet is just really one page. Now, I have a screenshot of this so I can actually write on it, but I do want to point this out. Remember, I said assets, in this case, assets equals your liability plus the shareholder equity. So take a look here. Notice right here, total assets, that's about $7 billion because it's in thousands. You have to add some zeros to it. And then notice here, liabilities and stockholder equity. They always put those two things together. And that's going to be the exact same number down here at $7 billion. Like Thanos and in accounting, all things must be balanced. So that is the beautiful thing about accounting and finance, but really accounting in this case when it comes to balance sheets. Now, accounting is boring. It can be very boring. I'm not someone who is excited about accounting in that way, but I do like balance. And when I was in college, finance, like the actual finance class was really hard, but accounting was easy because I knew they had to have the same number. But that's a conversation for another day. Let's go ahead and break it down. All right, so I went ahead and took a screenshot. As I mentioned, so it's the exact same thing that you're going to see on their website, but so I can draw and kind of break things down about what I'm looking at and just high-level overview of what goes on here. All right, so the first thing we notice, one of the first things is we start off with assets, okay? And the other thing that I noticed is I have 2 columns. And this is, I like this. I forget the name. I guess horizontal analysis is what they call it. The good thing here is I get to see 2021 and 2022 right next to each other. So I get to compare how did you do, so February 2020 to 2021. So it does have some of 2021 here. How did you grow? How did it move, right? Have things improved or not? I get to see that here. But remember here that this is a shot in time. So this is on January 30th of 2021, how much money did they have? How did things change at that one point? It doesn't tell me for the entirety of 2021. It's just on that day. On that day, this is the information that I have. So I'm really comparing, in a way, I'm comparing apples to apples from one year to the next. So let's take a look. Now, the first thing I'm looking at is again, the asset category. I would prefer, just like you would, right? I would prefer you have more assets every year. I want that to grow at a certain rate, right? Now, what rate is really going to depend on the business. You want to make sure you're comparing apples to apples and all that kind of stuff. But the first thing I'm noticing here is, y'all have way more cash, or y'all had way more cash in 2021 on that day than what you did a year previous. I want to know why. Did you just make a whole lot of money? Are you hoarding cash and not using it? You know, I could argue, right, that I want to make sure you have some cash, but that you're investing it and using it to do something, right? Make more stores or what have you. But I do like that. This is a decent thing. I like to have you to have cash, because in a situation like this in 2022, interest rates are going up, right? If you don't have cash, then what does that mean? You're going to have to borrow. You have to borrow at a higher rate. This is one reason why a lot of these newer tech companies, I've said this before, are dropping in value, because they may not have this level of cash, right? If you don't have cash sitting in the bank and you have to go loan and take out the money at a higher rate, that's going to affect your balance sheet, right? So that is one way that you can interpret that. Now you can see where their money is and what other how their assets are broken out. They have a lot in net inventories. This means, in this case, not every company is going to have inventory. This is the shoes, the golf clubs, all that kind of stuff. That is in their inventory. It's things that they could sell that is not sold yet, but they could sell it. That is going to show up here. Then you've got property, operating leases. So maybe they're like, they have a smaller Dick's Sporting Goods that they're selling or leasing to someone else. All that stuff is here. Okay. Now I don't get super deep into, you know, how is their inventory managed and all that kind of stuff. Now some people do. Just personally, I don't. What I like to see is it growing? Is it moving? Are you having more assets, right? And the most important thing that I'm looking at here is we got total assets at about 7.7 billion. What I'm looking at is, do you have more in assets than you have in liabilities? Now remember, at the bottom of the statement, liabilities plus your shareholder equity, there's going to be added together. That's going to be equal, but it does give us a breakout of just the liability by itself. That's what I'm paying attention to. So right here, I have my total current liabilities. This is really bills that need to be paid like within a year. That's at 2 billion. Okay, I have more assets than what I have here. And then I have my longer term liabilities, or just long-term liabilities as a whole. And that is, you know, maybe it's the long-term leases and things like that. Other bills that need to be paid, not now, but further down into the future. So I'm really looking at close to, what is that, 6 billion or so, 2.8 plus 2.5. And I'm not going to add all of them up, but I got more money in assets than what I have in liabilities. And I can also stretch this back further and see how has this changed from 2021 to 2022 and make a determination on whether or not that is a good trend. For years, really, and this is a while back, not necessarily now, for years, Netflix was in a situation where they had way more debt than what they had in assets. And now those things have kind of changed. And again, it's been years since that was the case. These are things I want to pay attention to. Because if my company is in serious debt and they're taking on just mounds and mounds of debt and interest rates are going up, that's going to be a problem for me. So if you are in a situation like, why is my stock dropping and why are interest rates affecting this company and it's not affecting that one? It might be because they have tons of assets and their liabilities are very, very small. Or it's the opposite. They don't have a whole bunch of assets, but their liability is huge. And that's something that you want to pay attention to. Now, the other thing too here is I'm not going to really get too deep into shareholders' equity for two reasons. Number one, I've already explained it. Number two, the screenshot stops. I can only screenshot but so much. But I can go back here and just show you real quick how much they have in shareholder equity. And remember, they break those two things out. There's a total shareholder equity at the bottom at 2.3 or 2.339 billion. And that did increase. So shareholders are getting more of the quote unquote profits, right? They own more of the company from 2021 to 2022. I think that is generally a good thing. Now, when you start to see a lot of ratios, financial ratios that people talk about, debt to equity ratio, long-term debt and all that kind of stuff, PE ratio, price to earnings, this is one of the things, and they use all financial statements for that, but this is one of the things they tend to look at. They will go through and pick out this information and say, this divided by this means that you can pay your debt, right, in 1 year. So that is going to be a positive debt to equity ratio, or asset to debt liability ratio, right? So that's one thing that people tend to do. Now, is it important for you as an investor? You have to decide what type of investor you are going to be. And this is one reason when we do our grading your portfolio videos, I say, look, you've got 30 stocks, you've got 50 stocks. You are not looking at 50 of these statements. And this is just one. This is just the balance sheet. Then you've got the cash flow statement and the income statement. Are you doing all three statements every year or every quarter for all 50 of those? The answer is probably no, right? You're probably not doing that. Now, the other half of the coin is, do you have to do this? Do you have to dig in and find and research to this level for every single stock that you have? The answer is no, you don't have to, but I do think it is important to understand what is going on and whether or not that company is growing, because the stock price going in one direction, the chart is only going to tell you but so much. Okay, it's not going to tell you everything. And even the statements are only going to tell you but so much. There are plenty of companies that have great balance sheets, right? Is what you may see on CNBC. It's a strong balance sheet. It means they've got cash. They can pay their bills and they're not sweating, right? Whereas a company that doesn't have that, you can see, y'all don't have that much money and your debt is 5 times bigger than the assets that you have. You're in trouble, right? Now, you don't see that by a chart, right? You can see a chart, stocks up, stocks down. A balance sheet would tell you like, y'all got to change something. Y'all not looking as nice as what you really are, right? So I think it is important. I think it is good to do. It is not necessary to do, nor does a balance sheet by itself tell you that a stock is going to take off. It doesn't. It would be great if it did, but it doesn't, because how you determine it and how you break it down may be different than I break it down, way different than Warren Buffett will break it down as well. But it is one important component when it comes to investing and really understanding the things that you hold, the things that you buy. Every balance sheet is different. Companies look at things in different ways and report things in different ways. But again, it does give me background information and knowledge into how the company is performing from a financial perspective. Having now I own shares of Dick's Sporting Goods, but I can sit here at this point in time looking at this and say, hey, and again, I would want to see the cash flow statement. I would want to see the income statement too. But right here, I'm like, hey, y'all got money. Y'all not going bankrupt. That is something I can tell from this, because if you sold off everything, you got, 7.7 billion, and your liabilities are like 6 billion or less. So if you did that, you could sell it, everything be fine, and at least I, as an investor, have a share, a portion of that shareholder equity that's left over. So I know you're not going broke. There are some companies that might be going broke or close to it. You're not going to do that until you check out the balance sheet as well as those other financial statements. All right, so that was about 20 minutes. I tried to do it in 15, but y'all know I be going on tangents. Sorry. But I hope it was fun. I hope it was educational. If you want me to go more into income statements, which is actually my favorite one, but again, you can't just look at one. But income statements, cash flow statements, feel free. If you want to talk more about those, y'all know how to get in touch with me. Just comment, like the video, and we can make more great content. All right, that is it for me. Talk to y'all later. All right, bye.